Alex Hormozi sold his last company for $46.2 million, and he just put out a video telling millions of people how to build their business so that they can one day actually sell it as well. And most of what he says in that video, he's right. But here's the part that separates the two of us. Building a company you could sell and actually selling it for the most value on the best terms that don't force you to sell your company short, those completely different skill sets. One is based in strategy and the other is a negotiation and a process run against investors and acquirers who buy companies for a living every single day and are going to do it better than you ever will. I spent over 10 years on Wall Street as an investment banker. I made managing director before I was 30 years old, and I've closed over $20 billion in transactions, most of that selling companies for the founders and owners who built them to exit one day. Selling businesses is not a theory for me. It is the one thing I've done year after year, deal after deal for my entire career. In this video, I'm going to react to Hormozi's advice on exits. I'm going to show you exactly where he's right, and then I'm going to show you the part his video never gets to, the part that happens once you're ready to sell, when you're in the room with the offers and the buyers in front of you, and you're actually making the transaction happen. Because that is the exact moment owners are either going to walk away with the best outcome of their life, or they structure a deal they never should have signed in the first place and they leave millions behind on that side. Let's get into it.
If you want to build a business that you can eventually sell, this video is for you. I've built and sold 9 companies. The last one I sold was 46.2 million. And so I'm just drawing on my experience from selling those to different partners, competitors, private equity, strategic buyers, so that I can tell you the things that I've learned so that you can get there much faster than it took me.
First, let's give the man his credit. He is not theorizing. Alex has built and sold real companies, and $46.2 million is a real outcome, especially for business that's founder owned and founder led. That is real personal wealth he created. Genuine congrats to him on that. When Alex talks about exits, he's earned the right to do so. Now, here's the one distinction I want you to hold in your head for the rest of this video. Hormozi sold his own companies, a handful of them across his career. What I did and what I do is very different. I sell other people's companies, Fortune 500 businesses, private equity firms, hedge funds. All the categories of buyers he just mentioned are the ones who own and acquire companies for a living. And I sat on the other side and sold companies into that world for them, deal after deal, for 10 years as an investment banker. And the size of companies, my smallest deals were typically $500 million to $1 billion plus. Over my career, I've closed more than $20 billion in transactions. So Alex is going to give you the founder's view from the exits he's lived through his own career. I'm going to give you the advisor's view from the other side of the table. When you pair these together, the founder and the advisor, you're going to get the whole picture. The founder who created the value in the business and actually built the asset, and the advisor who actually takes it to market, finds the buyer, understands how that buyer thinks, and is going to get you the best valuation when it's time to exit. That is when you actually understand how a business sale process works.
Dude, I think you're going about this all wrong. You're trying to sell the goose when you should be trying to sell the eggs. And this will be the common theme throughout this, is that most people are trying to sell the goose rather than sell the eggs. And you never want to sell the goose. You want to keep the goose and let it keep laying golden eggs, right? So that you can keep selling them. And for those of you who don't know the story of the goose and the golden egg, I'll read it to you. It's 2 seconds. There was once a countryman who possessed the most wonderful goose you can imagine. For every day when he visited the nest, the goose had laid a beautiful glittering golden egg. The countryman took the eggs to the market and soon began to get rich. But it was not long before he grew impatient with the goose because she only gave him 1 egg a day. He was not getting rich fast enough. Then one day, after he had finished counting his money, the idea came to him that he could get all the golden eggs at once by killing the goose and cutting it open. But when the deed was done, not a single golden egg did he find, and his precious golden goose was dead. There's something that creates value, and then there's the thing that is valuable. And so figuring out which of the things that you have in your business is the goose and which of them is the eggs is one of the highest leverage things that you can do, because you can build towards the exit intelligently.
This is a fantastic frame, and he is absolutely right. Do not sell the thing that produces value, sell what it actually produces. But notice who Hormozi is mostly talking to here. His audience is creators, coaches, personal brands, businesses where the founder is the goose, because the whole thing is built on their face, their name, their reputation, and that is incredibly hard to sell. So his advice to them is, right, keep yourself and sell the assets that are around you. Separate yourself from what you've actually built in the business. Here's where it changes for you. If you own a real operating company, for example, a manufacturer, a healthcare business, an equipment business, a services firm, and you're generating significant revenue and profitability, then for you, the company itself can be both the goose and the eggs. The whole asset is sellable. And now this is the entire game, and this is what the rest of this video is about. As long as the business can run without you and it is actually structured properly, which is exactly what he goes into in his next clip here.
Is there something that's dependent on you? If anything that is dependent on you for the business, it's inherently going to be significantly less valuable. Number one. Number two, is there a component of your business or of your customers' businesses that's very sticky or recurring? So for example, gyms, micro gyms for gym launch, intrinsically, they don't get sold very often. So there's not a market for small service-based facilities like personal training studios, things like that. A lot of people don't want to buy that. Why? Because they have key man risk at their level too.
This is the single most important thing he says in the entire video, and it is the number one thing I see destroy a company's value and its sellability at almost any valuation level. Let me give you the buyer's perspective, because I've sat in hundreds of these meetings presenting and pitching companies to private equity firms and strategic buyers. When I take a company to market, the first real thing every single serious buyer does is run it through a framework. What are the risk profiles in this business? What are the challenges it's going to face? And the big one is, what happens when the owner walks away or the current ownership group is no longer involved in the company? If the honest answer is the business is going to struggle or it will decline, the buyer does one of three things, and none of them are good for you, the seller. One, they're going to reduce the valuation significantly to account for that risk. Two, they walk away from the deal in its entirety. They're not willing to take on that kind of risk inside of the company they're going to acquire. Or three, and this is my least favorite because it undermines the entire reason you're actually selling your company, they tie up 50 to 60% of your value in back-end contingencies. So an earnout, which means you don't get all the value in cash up front, you have to stay in the business or at least stay invested in it, let it hit the targets, and hope that it actually pays out. They might also require you to stay on through a transition, 6 months, 12 months, 18 months, whatever the case may be, based on their risk tolerance of the business. And that is exactly where you end up getting stuck when you sell. You wanted to sell the business and walk away with your value. Instead, you're still inside the business, still running it potentially, except now you've got a new owner and you work for them. So Hormozi is completely right. If the business depends on you, it is worth dramatically less, both in value and in structure. But what he doesn't tell you is how to fix it. So don't wait until you are ready to sell your business to figure this out. The single best move you can make right now is to bring in someone who sells companies to look at your business through the buyer's eyes, years before you ever go to market. And they'll tell you exactly what to fix because they've seen what buyers react to. They understand how the buyer thinks. Every dependency, every risk you remove before you go to market is going to translate into real enterprise value that is added to your final number when you exit. Now, we've done this with companies again and again. We've helped them identify all the risks they didn't even know they had, the ones that they were going to 100% run into the moment they went to market and spoke to buyers, whether it's contracts, customer concentration, a management team they can't run without the equity owners, a product or a single client that the whole business actually depends on. Every single one of these, if you can eliminate it before a sale, is going to lift your valuation and the multiple you ultimately get when you sell your company.
What's interesting is that in investing, it's a volume premium. So basically, the more profit you have, the bigger the company is, the bigger the roll-up is, the more you get per. And it's because big money is lazy. And so they will pay a premium to not have to do as many deals because deals are costly. It costs a lot of time, a lot of attention. And so if you have to do 100 deals versus doing one deal, you'll pay a premium to only have to do one deal. And so if those individual accounting firms could sell at, call it 4 times earnings on their own, right? If they can sell in aggregate together for, call it 12 times earnings, then even if they give up 30% of the 12x, they're still double as good as they were before. And so everybody wins.
Okay, this is one of the most important financial concepts in the whole video, and he is completely right. The valuation of your company is not fixed. It is not some set number, and that is genuinely great news for you if you want to sell, because it means the value is movable. You can actually increase what your company is worth. The same exact earnings, the same exact profit can be worth 4 times earnings or 12 times earnings. There's a wide spectrum depending entirely on how you package the business, how you sell it, and ultimately who you sell it to. And most owners have no idea how movable that number really is. Let me walk you through what this actually looks like on a real transaction. I worked on the sale of a company called Remington Outdoor Company, one of the oldest, most iconic firearm makers in America. The brand goes all the way back to 1816, more than 200 years old. When they came to us, they had a single offer to buy the entire business, around $60 million. One buyer, one offer. And on the surface, that honestly sounds really good. That sounds like a great deal. You've got a buyer, you've got an offer. Most business owners would take it because $60 million feels significant, it feels institutional. And if a buyer is willing to pay that, that must be what the company is worth. We told them to reject that offer, and we did the opposite of grabbing onto the very first easy transaction they had. We went into the business and we understood it had different components inside of the business, different divisions, and we broke it apart and packaged it the right way to sell. Remington had an ammunition division, they had a firearms division, and inside of those they had different divisions as well. So when you sell these together as one company, you get a single blended multiple and typically a lower one. If you sell them separately, you've got different buyer pools, different deal dynamics. Ammunition business alone commands a higher multiple than the firearm side. They're just two different industries and verticals. Value the whole thing as one bundle, and you're going to give away the entire premium that you would have got splitting it up. So we ran a real competitive process. We analyzed the business, optimized it, found the best buyers, brought them to the table, and made them all compete for the different divisions in the company. That same company, the one with the $60 million offer, sold for a $160 million valuation, a $100 million increase over the offer they almost accepted. Same exact business, same exact earnings. Nothing about the company actually changed. The entire difference was in how it was packaged and how the process was run. One more example. I represented a family-owned equipment rental company. It was privately held out in the Midwest. They came to us with a $250 million offer in hand, and they thought it was great. They were ready to sign and sell this company. This business was doing around $40 million of EBITDA at the time. We told them, hold on a second, you're preempting your own process. Let us make sure you're actually maximizing this exit. So we ran our process. We came into the company. We identified a strategic buyer who would actually pay more. And inside of about 3 months, we sold that business for $280 million for that family. $30 million straight into that family's pocket because they had the right advice and they ran the right process. So when Hormozi says the premium exists, it absolutely does. I want you to believe him on that. But understand this, that premium is not automatically baked into your company. It only shows up when you run a real competitive process, when you know how to present and package the business correctly, when you have access to the best buyers in the market. That first single bid is almost never the best one. And there's one more thing that he touches on that's also worth pulling out in his video here. Buyers will pay a higher premium for bigger assets. That is absolutely true. Generally, the bigger your company, the higher the multiple you can command inside of your industry. Now, if you compare multiples across industries, a tech or a SaaS business will trade at a very different multiple than a plumbing or HVAC business. However, within the same industry, a $1 million EBITDA business, $10 million EBITDA business, and a $100 million EBITDA business are going to be very meaningfully multiples different on that scale. And if you could scale your business up, that itself will become a lever. And if you can move your 4 times towards that 12 times or whatever the top of the range is inside of your industry, you're going to reap the benefits of that valuation to your business. Real quick, I hope you're getting value out of this video. If you own a successful company operating and generating significant revenue and real profitability, and a successful high value exit is anywhere on your horizon, even if it's a year or 2 out, just understand this. The worst possible time to start thinking about how you sell is the moment an offer lands on your desk or the moment you suddenly have a need to sell. So I've put together a short breakdown of how a proper exit process actually works and how owners and founders like you get to the kind of exit that's actually worth celebrating at the end. It's linked down below. Go ahead, check it out. And now we're going back to the video because this last point, this is the one that actually protects your valuation.
You have to zoom all the way back out and think of your business as a product and an investor or potential acquirer as a customer.
This is exactly right. And it's exactly the perspective you need if you're ever going to sell your company. Your business, when you sell it, it is a product. And the buyers, the investors, the acquirers, they are your customers for the business. So really, you have 2 sets of customers. You have the customers who are paying you every single day. They're the ones creating your operating revenue, your cash flow. Those are your business's day-to-day customers. And then you have a second customer, which is a customer for the business itself, the ones who are going to actually acquire the entire company or invest in your business. And just like any other product, your business sells for a higher valuation when it is positioned properly and packaged properly and marketed to the right buyers in the right way. And this is where most business owners will fundamentally just get it wrong. They don't understand this process at all in terms of how they should sell their business and get the maximum valuation. They'll go to their accountant or their lawyer and they'll ask, who can sell my business? And they get referred to a local business broker, somebody who's going to throw the company up on a website and wait for inbound requests. And that's a listing. That is not marketing your company, and is not going to drive a process to get the maximum value. And it's why so many business owners end up telling me when I speak to them the same thing. I don't know who to go to sell my business. I don't feel like I'm going to get the best deal. I don't really understand this process, and I know there's real value inside of my company that I want to unlock, but I don't know how to do it. This institutional process, the one I run, is a completely different world, and it's exactly how that value gets unlocked. It treats your company the way it should be treated, as a product worth competing over. You don't approach one buyer and hope. You're going to bring the best buyers to the table and make them all understand the opportunity and make them compete to buy your company. And that's the gap between what Alex is calling the 4 times exit and a 12 times exit. It has nothing to do with luck or with hoping that the right buyer is going to suddenly show up and give you an offer. And again, think about your business, your own business for a second. You would never sell your own product or service by just listing it on a website and waiting for a buyer to show up. You drive traffic to it, you would create demand, you'd build that premium feel so that people actually wanted it. So why would you hand the single biggest sale of your life, your entire business, to someone who does the exact opposite of that process and won't get you the value? Now, here's what I really want you to hear, because Hormozi's video takes you right up to a point and then it stops. And that part that comes after that, that's where the most intense, most important part of the entire sale process actually happens. He's showing you how to build the company, how to make it valuable, how to structure it the right way, and he brings all that is correct, but none of it is the actual negotiation or the process that happens after that point in time. None of it is talking about the day you launch, you go to market, the day that you get the offer, it's real, the day you're sitting across the table from a private equity firm looking at you and deciding what they're willing to pay based on your process. And that's actually where the deal is either won or lost. And if you're not sharp here, if you're not tactical, you're going to quietly, unknowingly shrink your own valuation. You're going to shrink your options, lose your leverage in the deal, and you might end up locked in a transaction that doesn't make sense for you, either on value or on terms, because the buyer sitting across from you, they negotiate acquisitions every single day, every single month. Dozens and dozens of them. They have years of experience and they've put hundreds of millions of dollars behind acquiring companies. So they're an expert. For you, this is most likely the first time you've ever done something like this or sold your company. So quite frankly, the chips are not stacked in your favor to do this on your own. Let me give you one example of how things can go poorly and an owner can leave significant amount of value in their sale. The headline price is a trap. A buyer offers you $100 million for your business and you're thrilled. You got the offer, you got the letter of intent, you're preliminarily celebrating. But then you actually read the offer and 50% of that number is built in as an earnout. It's deferred payments tied to the business hitting targets for years after you've already let go of the business and lost control. So half of it is gone, it's contingent. Then they tell you another $20 million is rolled into equity in their company. So now you're hoping that their business is going to be worth more down the line than the day you sold it to them, even though you don't control it. That's risk you have to carry as well. So that big, exciting $100 million headline number, the actual cash that hits your account the day you close is a fraction of that, around 30%, $30 million. And meanwhile, a lower headline offer, say $50 million, all cash, paid up front, no contingencies, could have left you genuinely better off with a cleaner exit than the one that you got excited about at $100 million. Now, is a $100 million deal actually worse than a $50 million deal? We don't know. You'd have to understand the specifics of each transaction and what's built into it. But just looking at the headline alone, you can see how these differences can really be significant once you read past that number. There's so much nuance in how a deal is actually structured. So building the goose and the eggs is the first half of the equation. That's the first. You got to do that real work. You got to actually turn that goose into value, into cash, into an exit that you could actually walk away with. That's the second half. That's the skill of running the process and the negotiation. And it's a craft. It's an art skill on its own. You're not going to pick it up from a video. And quite frankly, you really don't want to be learning it on the one day it matters most, when you're sitting across from someone who has done this 1,000 times. They want to buy your company and you've only done it once. So here's where we land watching Hormozi. He is correct. You want to build a company that doesn't depend on you. You want to make the revenue in your business sticky. You need to understand the dynamic between your goose and your egg and what's really driving the value inside of your business. If you do all of that, you'll have a company that is genuinely worth selling, one that's actually sellable. You're going to complete that first half. However, when it comes time to actually sell it, remember the part his video did not cover. The single first bid is rarely the best bid. You need to increase the value over time. Do not sell your company short. The headline price is rarely the real price as well. You need to understand all the nuances and dynamics that go into top line to the actual walkaway number. And finally, the private equity firm, the acquirer that is sitting across the table from you, they do this for a living. They're day in, day out. They acquire, negotiate, and structure deals all day long. So make sure you're actually equipped to sit across from them and negotiate the best deal you can when you want to sell your company. Now, working with private equity and selling selling to them is where I've spent my entire career. If you own a successful business and a real exit is on your mind, you want to build an outcome that you can actually celebrate and feel amazing about when it's all said and done. That's the exact conversation I have with business owners every single day to help them make it happen. If your company is in the $10 to $250 million range, that's usually the sweet spot. I'm going to help you out. And if your company is even bigger than that, no problem. I've worked with companies much larger than that, so you're in a good spot. There's a link below to book a call with me and see exactly how I'd approach selling your company and building the kind of exit that you actually want to have possible, and so you can understand what that process will look like. There's no pressure. Everything is completely confidential. You're only going to sell your company one time. So my honest advice, it is worth getting it right every single time.